Recorded before. Okay. So here we go. So hi, I'm Lynette Clemens with Keller Williams Sonoran Living and the Arizona Value Builders team. And I want to thank you here for all of you for being here today. This is our very first Zoom class on investing, and there will be many more. We're going to have them every single month throughout this year. And we're going to be talking about 1031 exchanges. We're going to be talking about whether we're holding, whether we're flipping, financing, the legal implications, taxes, property management, all kinds of things during this entire year. But we want to start out with the basics today of what does that look like, right? So we were just talking before I hit record really quickly of the process of, when you are looking for investing, you have to have a roadmap to get from where you are to where you want to go, right? And a great team around you that can help you with that vision to make it not just a dream, but an actual reality. And the difference between a dream and a goal is a date, right? So having a starting point so you know when you're going to be able to get and hit that goal is always great. Me in the process as a realtor, I help you find the properties. We analyze the budgets, go through things like that. We help you buy the property. And then, we have a team of people that we can hand off to help you manage the property, help you get the loans on the property, servicers for 1031 exchanges, like we said. So this is a place where I'm hoping people can come and learn a little bit about the process. And then as we go along, engage in it. And obviously you can reach out to any of us at any point with more questions, and we'll make sure that all of our information is in the chat so everybody can reach out to us. So I do want to turn it right over to Dan right away, and then he can talk a little bit about himself. Really quick, I'll just say I have been in the business 20 years. I didn't say that. It's a long time. Most of us have been in the business for a long time. I don't think there's any newbies on here. So that's great as far as business goes. So I'm going to share my screen with you. I'm going to make you the host, Dan, and then I'm going to mute. And I just want you to go ahead and tell us everything you know in 10 minutes or less, maybe 15.
All right. Thanks, Lynette. My name is Dan Zufall. I'm the leader of the Intelligent Mortgage Planning team. I've been in the mortgage industry for the past 24 years. And have a lot of clients who look at investing in real estate. So we try to help them make good decisions. So the main focus of my topic today is really going to just be going over the lending process, kind of 101 of how the system works. How do you qualify for an investment property? What are the requirements? What is good to know? And focusing today really on the buy and hold aspect, not the flipping or the 1031 exchange. So just how do we get in? How do we properly look at a buy and hold property, and what should we be expecting for the type of return? So I'm going to share my screen. I'm going to go through a few different spreadsheets really that we've created over the years that will help visually just kind of understand how the process works. Let me know if you can see my screen. Let me know if you can see a spreadsheet or not. Okay. So this is a very basic underwriting analysis that we do for every client, really looking at what is approvable. So I just put in a basic example where we've got investor John here. He's got a 780 middle credit score. So mortgage financing, we pull all three credit bureaus. The middle of the three is the qualifying credit score. We're going to do an income analysis individually specific to each client based on whatever their income source is. To keep things simple, I just said John has a base salary of $100,000. So gross income, not net income, is used for mortgage financing. So we look at gross income from all sources. Depending on the source, there may be a average that's used. A 2-year average is used for, say, commission or overtime or bonus. Self-employment is analyzed a completely different way. But for simplicity's sake, let's just use a base salary of $100,000 a year. So every month, that's $83.33 a month. And mortgage financing in its most simplest form calculates a maximum debt to income ratio, which means there's a maximum monthly payment that you're allowed to have for all of your debts. For conventional financing, specifically within investors, the maximum that generally the conventional financing software would ever approve is 45%. There's different debt to income ratios for different situations, but from an investment standpoint, 45% is generally the maximum. So what does that mean? We take the monthly gross income, 83.33 a month, multiply that by 45%. So that's 37.50 a month. That within the lending format system, you're allowed to have 37.50 a month in debt payments and generally be approvable by the underwriting software as long as you meet the other financial criteria with good credit. So let's say John currently has a primary home. Let's say he's paying $2,000 a month on his primary home. Let's say John has a car, he's got a student loan, he's got a couple credit cards. The credit report is going to give us a snapshot in time of existing debt balance and payment, and the payment that's reflected on the credit report as far as minimum payments factors into the debt to income ratio. So if we say $2,000 a month for his current house, $850 a month in other debt payments, John essentially has about another $900 a month that would be approvable to add another property. Well, how does that work? That doesn't seem like a lot of money. How do you go buy a property? Well, the beauty of buying an investment property is that you actually get the benefit of future rental income to offset the mortgage payment that you're taking out, and you simply have to qualify for the difference in a debt to income ratio. So for example, let's say you purchase a property. I'm just going to use a base example today. We're buying a property for $350,000, single family home. We're going to pretend it's going to rent out for $2,500 a month. So we won't get into, what should you buy and, different scenarios. We're just going to use a hypothetical example for everything I show you today. Buying a single family house for $350,000 and $2,500 a month rental income. So the rental income from a qualifying standpoint, the lending format allows you to use 75% of the rent, which is $1,875 a month. Now, let's say this investor wants to put 25% down, which I'll show you a couple examples, 25% down. As a seasoned investor, as a long-term investor, that's kind of the sweet spot of where you want to be from a down payment perspective to make the financing as cost effective as possible. So we'll get into that in a minute. But let's say the monthly payment with 25% down on $350,000, including taxes and insurance, is about $2,121 a month. So if we take $2,500 a month gross rent, 75% of that is $1,875. We can offset the payment by that 75% of rent. So I only need to qualify as an investor for $246 a month of the mortgage payment, which is actually $2,121. But as long as the amount I have to qualify for is under the amount that I have in room from a debt to income ratio, that should be approvable. So that is one of the major benefits of buying investment property, is that you don't have to qualify for the entire payment. You get the benefit of theoretical future rent once you acquire it. Now, the rent is determined by obviously the market, but also an appraiser is required to not only appraise the value of the property, but they're required to do a rental comp analysis to figure out what should this property rent for based on other similar properties in the area that are also rented. So that gets supported by actual market data. So it's not a number that is exactly known until the appraisal is completed, but working with a good property management company, you can get a good ballpark of what the property should rent for when you're looking at running your own numbers. So let's get into what is required. So this is a conventional financing, just standard loan to value, LTV, loan to value, that's a term you want to get familiar with. What are the maximum loan to values allowed within standard traditional conventional financing, which is really where you want to be. That's where the most attractive financing interest rates and terms are going to be. As a principal residence, primary home, so if you're going to live in the property, if it's a single family house, you can put as little as maybe 3% down, more traditionally 5% down. 3% down does have some rules to it. There's some income criteria, potentially first-time home buyer rules. 2 to 4 unit property, so duplex, triplex, fourplex. This is a recent change that's actually really, really powerful. It used to be that you had to put a lot more down. If you're buying a multi-family home, it was 15% down as a duplex and 25% down as a 3 to 4 unit, even if you were going to live in it. Now, Fannie Mae and Freddie Mac have reverted back to some old guidelines where they will allow you to purchase a multi-family property with only 5% down. So that is one powerful tool that we'll come back to. But as an investment property, so if you're purchasing a property that you're not going to live in, a single family house, the minimum you can put down is 15%. If you're buying a multi-family property, 2 to 4 units, the minimum you can put down is 25%. If we look at a couple of other things, and I know this will look a little bit like Greek at first, but this is what's called the loan level pricing adjustment matrix. So this is how interest rates get impacted based on your individual credit score, down payment level, property type, and occupancy type. So when I say 25% down is generally the sweet spot for investors, that's because that is where most of the pricing adjustments for financing are minimized. They're not altogether eliminated, but they're minimized. So for example, let's say I have a perfect credit score, which is now 780 and above. Let's say technically I can put 15% down. So that would be 85% loan to value. So this would be considered points. So this isn't an adjustment to the rate. This would be adjustment to upfront costs, which also can indirectly impact the rate. But we'll just consider this points for now. So let's say you're buying, primary residence with no points. These would be additional discount point adjustments, so upfront fees. We'll come back to that. Happy to answer any questions later on this topic. But with 15% down, the technical minimum, so there's 3/8 of a point simply for credit score and down payment level. These are all aggregates, so you add them together. Let's say I'm buying an investment property. Let's say it's not a condo. Let's say it's just a single family house. An investment property with 15% down, I'm going to get hit with 4.125 additional points just for it being an investment property. I can't put 15% down on a 2 to 4 unit as an investor. As a primary home, I could. But let's say if I put 15% down, then I know if it was a primary home, I would be paying 3/8 of a point. So let's say the interest rate today is at 6.5 for an investor with for a primary home purchase with perfect credit. Then let's say they're going to pay 3/8 of a point for that 6.5% rate. As an investment property, they're going to pay 4.5 points for that 6.5% rate, right? So you can increase the rate to help absorb some of these costs. So let's say you go 7% and then you're only paying 3.5% points up front, something like that. So it's all individually specific, depends on the market, what's going on. But the more you put down, the less of an impact these loan level pricing adjustments are going to have. And obviously the more you put down, the cheaper the payment's going to be, the better it's going to cash flow. So when you get to 25% down, if you have a really good credit score, there's zero impact, even as an investor, to the pricing. Even if it's a condo, let's say, there's almost no impact for the fact that it's a condo versus a single family house. As an investment property, instead of paying 4.1 points, it's 2.1 points, which is much more palatable and much easier to actually build in to the financing within either an interest rate adjustment rather than just paying upfront points. And then you'll see if you're buying a 2 to 4 unit property, the impact is minimized. So what does that all mean? We'll jump ahead to a couple of other things. And we'll just look at monthly payment. Okay. So let's say we buy this $350,000 house. Let's say we put 25% down. Let's say we're going to go with an interest rate that helps offset some of the points a little bit as an investor. So let's say the current market rate with really good credit, 7%. And let's say property taxes and insurance estimated $250 a month and $125. So that's where we get our total $2121. If we were going to put, say, 15% down, and keep in mind, this is a rental property, so we can't necessarily control what the market will bear for rent. We want the property to cash flow. So let's say it rents for $2,500. We want to make sure that we come in with positive cash flow if at all possible. If we come in with 15% down, then let's say we don't take an adjustment to the rate. We take the same rate. We're just going to pay the additional cost for the financing up front, the additional 2 points, 2.5 points really. But we're also going to have some PMI because we're putting less than 20% down. And we've got taxes and insurance. So out of the gate, we're not necessarily cash flowing a whole lot. We've got the tenant potentially paying the majority of the payment. But as you start to acquire more properties, and from an ideal return on investment standpoint, getting to a 25% down payment level over time is really the sweet spot currently from a financing standpoint. And that's that stood the test of time for quite some time of that being the case. And that is also a reason why Fannie Mae, Freddie Mac required 25% down on a 3 to 4 unit property as well. So let's look at a little bit more advanced. What type of return should we expect? So this is a very detailed analysis, just looking at, okay, let's say we buy the 350 property. Let's say we put 25% down. Let's say the current rate 7%, same assumptions, 2121, rented for 2,500. So out of the gate, we're putting in our initial investment. The property is cash flowing. We have to make some assumptions about what we expect to happen over time. There's some tax implications involved. We can depreciate the property, which is one of the major benefits of owning rental real estate, is you can depreciate the value of the property over 27 and a half years per the IRS. You can't depreciate land value. So you establish price minus land value, and you get to depreciate the difference. Let's say it's a single family house. We look at our tax bracket. We've got taxes, insurance, potentially HOA, potentially property management fees. We know that those are going to increase over time. We can make assumptions of what that's going to be. All of this is, just interchangeable that we can play around with. But let's say, those costs increase 1% over time. It's probably conservative, but that's what the assumption is for now. Let's say the property appreciates on a long-term basis, averages about 3% a year. Obviously, during COVID, we saw some extreme appreciation. That's not going to be the norm forever, but we would expect the property to appreciate over time. The rent's also going to increase over time. We want to factor in budget for expenses, maintenance to the property. Ideally, we want somebody else to manage finding tenants, managing the tenants, managing repairs. That's a decision that as an investor you want to make. You want this to be passive income, not a part-time second job. So that's where property management will allow this to be a much more hands-off experience. So there will eventually be some turnover, and there will eventually be some vacancy. So let's say on average, every year and a half, we have a new tenant. Every 5 years, we have a month where we just didn't have a tenant. So if we look at the nitty-gritty, and I won't explain everything that goes into this, but this really looks at it from a detailed investment return on investment standpoint, and understanding why buy and hold real estate is a get-rich-slow strategy, but one that's extremely powerful over time. This factors in all of the pertinent things that we have to think about when investing in real estate. It looks at our net annual cash flow. It looks at, how much did the tenant pay down our mortgage? How much did our property appreciate using all these assumptions? So year one, we put in our $87,500 initial down payment. Let's say we bought the property, we had to pay some costs, we had to do some initial repairs. Let's just call it 10 grand acquisition just to get in. So that's our initial cash investment. From there, now we've got the tenant paying it for us. So if we look at year one, the return's not going to be amazing because we put a whole bunch of money in, and the cash flow is something that builds over time. So a lot of people think about passive income. Passive income is a benefit that's a long-term equation. In the interim, the major net increase to our net worth has to do with how much the balance is reducing as well as how much the property is appreciating. So our net annual profit year one is about $14,346, and over time that's going to build as the rents increase and as the home value continues to appreciate. And if we look at the internal rate of return and the aggregate profit from investment, we'll see, and you can kind of see at the top, so year 1, 2, 3, 4, 5, 7, and then it's going to jump to year 15, 30, and then in year 31, it's paid off. So if we look at jumping ahead to say year 15, our aggregate profit from this investment, so we put in $97,000. We so far have earned $342,000, a combination of rental cash flow, net after expenses, appreciation, and mortgage reduction. The ultimate goal for most investors is to get to the point where the property is free and clear. When the property is free and clear, that's when we truly have large passive income that will support our other financial goals, retirement, etc. So in this example, passive income is around $42,464 from this single property. Additional appreciation will continue. At that point, the property is going to be worth more, so another $25,000 annually. If we look at this from an internal rate of return perspective, it's a little bit north of 10%. So if we compare that to other investment opportunities, that's a pretty good return, and it's just important to keep expectations of what to expect on a buy and hold. And this is assuming you haven't sold the property. So if we look at, an actual point of sale analysis, this also factors in, okay, we have to pay some fees to sell it. There may be some capital gains on the sale if we don't 1031 exchange it. That's where the 1031 can become powerful. There's some depreciation recapture tax when you sell if you don't 1031 exchange. So another reason to potentially 1031 exchange. But at the same time, long term, we look at, say, 15 years, we put in $97,000. We got some cash flow along the way. We were able to walk away with around $240,000 in actual profit. And again, long term, it just continues to build. So this is something that we'll work with investors on individually to help analyze different properties. What do they have to pay for? What do we expect it to rent for? How many units? All of these assumptions are very case by case, individual specific, but it just helps look at different properties and decide which property is going to provide the best return. And ultimately, most investors don't want to do this once. They want to acquire multiple properties and get in a position where they have multiple properties earning passive income long term. So I'm going to stop there. I probably passed my 10 minutes, Lynette. The one additional comment I will make is the challenge for most new investors is, well, how do I get in the game if I need 25% down? So from a new investor standpoint, one of the most powerful strategies is to buy the investment property first. So before you acquire a primary residence, purchase a property that you eventually want to convert into a rental property. For these reasons specifically, the amount of capital that you need to put in if you're buying specifically as an investment property, obviously 15% down is the minimum. From a return on investment standpoint, it's really 25. If you go and you purchase a single family house that you eventually want to convert, then you could come in with as little as potentially 3% down, 3.5% with FHA, 5% down for the vast majority of people buying with conventional financing. But it helps to minimize the amount of capital that you need to really enter into the market. Now, when you're purchasing as an investor or as a primary home, excuse me, you're committing that you're going to live there for at least 1 year. You have to actually live there for at least 1 year to meet all the occupancy requirements. After 1 year, you can move out. You can convert it to rental property. You can go acquire another property, maybe the property you wanted really for yourself long term. And it's perfectly fine to convert that to a rental property. From a financing perspective, you have that right. The even more powerful strategy, and this is kind of where the house hacking topic comes into play, is looking at purchasing multifamily as your first primary home. So duplex, fourplex, triplex. The inventory in the Phoenix area for multifamily is not, as good as we all would like it to be. But theoretically, you could purchase that duplex, put only 5% down. Now you have a renter in one side. You live in the other side for a year, convert that unit to a rental, move out, go buy the primary home that you really wanted, and you only had to put 5% capital in. So we're out of time to kind of show you some math behind how that works. But I'd be happy to connect on an individual basis if anybody wants to review that in further detail. The only thing I will mention is from an underwriting standpoint, you have to move down in units. So most people, what they try to do when they're trying to accomplish the house hacking formula is they're trying to buy a fourplex, move out a year later, buy a triplex, move out a year later, buy a duplex, move out a year later, and then buy a single family. If you go down a unit, you can move in and call it a primary residence and actually have it be a primary residence, of course. But if you try to go from duplex to triplex or single family to duplex, the underwriting system will not allow you to do that. They will consider that an investment property unless you actually physically sold your single family and that new property is the only one you own. So there's a lot of, it's the number one reason for occupancy fraud is calling it investment property when it's not. So there's a lot of checks and balances, but you can walk down the ladder and be able to do that. And really at the end of it, the goal would be to have 9 units or 3-2-1 to build that portfolio and minimize the capital requirements to really get in the game. Instead of 25% down, it's 5% down. Obviously, you need to be able to afford the payment, and the cash flow with 5% down is going to be a different equation. You're going to be subsidizing that property. The rent is not likely going to be covering it. But from a long-term perspective, eventually the scale will tip and the rents will continue to rise. Your payment will be relatively fixed. And eventually those will cash flow. So you just have to be able to absorb that subsidy in the meantime. All right, Lynette, I'll stop talking. Happy to answer any questions, but just wanted to make sure I covered that.
Hey, Dan, you have one question.
Yeah.
Yeah, it's from me. But do you see more like young people today buying duplexes and renting out one of them and living in the other to get the benefit of the future projected rent in situations where they might not be able to afford a house otherwise?
Absolutely. Yeah, because affordability, number one, not even if they're trying to do the house hacking formula. Just the fact that you have a tenant, in a unit paying for part and potentially more than half of the home payment, that is definitely more common. Different markets, different states have more availability for multifamily. So it's a strategy that's extremely powerful and something to be aware of if you don't have a primary home yet, you want to eventually be a real estate investor. That's a really, really good way to do it. And it's a little bit different math where, when you're buying a multifamily and you're going to live in it, you're not offsetting the payment with rent. You are adding 75% of each rental unit to your income to then increase the amount that you could potentially get approved for. So you still have to qualify for the full payment, but you get the benefit of 75% of the rent from the units that you're not living in, which helps increase your purchase price to how much you can afford, because obviously multifamily homes are going to be a little bit more expensive generally than single family homes, single family starter homes. But that is a definitely powerful strategy and something that's much more common, especially with the reduction from Fannie and Freddie to allow 5% down again.
Awesome. Thank you so much.
Dan, I just wish, we all would have had this information before we bought our first single family and we could go back and buy a fourplex and do it the right way. But for some of us who bought a house and then down the road decided we wanted to get into investing, how do you see people do it? Do you see them saving up another amount of money? Do you see them then leveraging the home they have and pulling out? And also, two-part question, not even the same question, just two questions. Cash, right? Is it in your mind, is it smart to take, say, 300,000 and buy cash, one, or take that 300,000 and buy 4 properties, kind of leverage it that way with loans? What do you see? What do you think?
Yep. So it's a combination so first, to answer the down payment question, we do see people taking equity out of other properties, say their primary home, maybe doing a second mortgage or home equity line of credit to help fund the down payment requirements. We also see 401k loans. The IRS allows you to borrow up to 50% of your vested balance to a maximum of 50,000 without it being a taxable event. And then there's an interest rate you pay back to yourself. So technically that's a 0 interest bearing loan. You have a payment on it. You're gonna have a payment on the second mortgage on your primary house. So it just, you have to factor all those things into your cash flow and the investment property decision. But because the capital requirements are pretty heavy when you're getting into the game, sometimes you have to get a little bit creative to get in the game. And then the second part of that question was cash versus financing. The major benefit of investing in real estate is the leveraged return on investment. I'll see if this will quickly give us an ROI. But let's say we pay cash for the property, 100% down, so we don't have any financing. You'll see that the return on investment is going to go down because we're using all of our own money to acquire the property. So instead of a 10, 11% return on investment, we're reducing that down to 7.5. The major benefit is the use of other people's money, using the bank's money to acquire that property. And instead of buying 1 property, we could potentially use the same capital and buy 4. So that is really the power of real estate in general, is because it's so easy to obtain financing for real estate at relatively good terms. So your investment return is much greater by leveraging the use of debt. It's called a leverage rate of return. It's going to be higher.
Thank you. Thank you. Anybody else have any questions? No? Okay. Christine, we can't see you, but we know you're there.
Yes, I am.
Christine, do you want to explain, is there anything different between an investor and the title company and a regular sale, and kind of tell what you do a little bit?
The difference pretty much is we do offer the investor discount fees. If you are buying an investment property, we can discount our title policy fee and our escrow fee. And then if they're firefighters, teachers, police officers, and military, and anybody over 55, they also qualify for those particular discounts that we offer as well. But other than that, it's all pretty much the same standard across the board. We are the neutral third party that handles all the money and issues all the payments and records all the documents.
Easy and fast.
Pretty much.
Yeah, she's there from the beginning to the very end of the process, and we love Christine. We can't see her face, but we love. Okay, did you have anything else to add, Christine?
I also wanted to I didn't know if I said it, we also have a teacher's discount. So if we have teachers moving in state to take jobs here, we offer that discount as well.
Is that for investors? It's for investors or first time home buyers? Doesn't matter. Everybody gets this kind of
I just need to know at the beginning when the contract's open that they're teachers or police officers or medical.
Question. Does Drake's Title still offer the home warranty to investors if they're buying an investment property, or is that just for first time?
I will have to find out that information for you because I thought it was just first-time home buyers.
Okay.
But I
Like-
can double check and find that out for you and let you know.
Yeah, definitely. Thank you, ma'am. Appreciate
You're welcome. Have a great day, you guys.
you too. Thank you. And now we definitely have to talk about property management part, right? Because that's a big deal. And you know, when you're wealth building, you obviously want a professional property management in there because you don't want somebody calling at 3 a.m. when your toilet is stopped up. You know, there's a lot of things that go into that. So I'm going to pass it over to Suzette right now. She's somebody that I've worked with for in the same office for many years and is a friend of mine and is somebody that I will always recommend for property management when it comes up. So I'd like to turn it over to her and let her talk about it. She's also an investor herself, so she'll have some information on that.
Thank you. Yep, I've been doing property management and investment real estate probably about 35 years now, actually. And I always like to explain, a lot of people think that it's a situation like the hardest part is just getting the house, which it is. It's the first big step, obviously. But once you have it, it needs to be protected. It's a lot of money that you just put into this. And if you don't have somebody to professionally manage the property, it's just a myriad of things. Over the years, we've seen a myriad of things that can go wrong. And I always like to kind of try to say, if you had $400,000 and you wanted to invest it in the stock market, most likely you wouldn't just go out on your own and do that, manage it yourself, because it's a lot of things to know, a lot of switching and changing and buying and selling in order to make your investment grow. And that's kind of the same with property management. Arizona has an incredible amount of statutes relating to managing a property. And it doesn't matter if you're a licensed real estate agent or not, they expect you to know them, follow them. And if you don't, there's some big penalties and some big problems coming your way if you don't. So if you're find yourself in court and you're representing yourself because you manage the property yourself, you can't say to the judge, well, I'm not a real estate agent, so I didn't know that. Not going to matter. You have to know all the laws. And so having a management company, we know all the laws. You don't have to worry about knowing all the laws. You're still responsible as the homeowner, but in our situation, we come alongside you and help you navigate that. And so, and as Dan mentioned earlier, yes, we have specific ways of determining rental comps. It's a science. There's a lot of variables that go into it. It's not just 4 bedrooms, 2 bath, 2,000 square feet. Here in Arizona, you can be literally across the street in a different neighborhood, and the rents could be $100 to $200 or more a month difference. Same square footage, same bedrooms, but that much difference in the rental price. The biggest thing I find when people are managing their own properties is, number one, not having the correct price. So many people that come to us, they're losing $200 to $500 a month in income because they don't have the right price. They're not aggressive. They don't want to be aggressive. No one likes to be aggressive, especially when you're dealing one-on-one with the person, because it's a little awkward. They know you're the owner and you don't want to feel like you're gouging them. So you lower it to be the nice person, but you're just leaving money on the table every month. With a management company, it's a business. It should be a business for you too. That we have an aggressive formula in determining the price. And the second thing, as far as renting, is finding a qualified tenant. That's giant. And nobody, unless you're a company set up with the screening company, has the ability to run a full comprehensive report on this prospective tenant. You might be able to get a generic credit score, maybe from an online, but it's a generic credit score. It's not a comprehensive credit score. And also you're not able to get the full comprehensive criminal background or the eviction history either. You have to be set up with the screening company, and there's a lot of hoops you have to jump through, a lot of qualifications before you're even allowed to run these types of reports, and they're important. The front end of the management, finding a qualified tenant is huge. So the other thing, I guess, besides just managing it through the year, we know what's required as far as repairs. We know we manage the tenant during the year. Tenants oftentimes have ideas of what they want to have replaced or changed or whatever. We discuss it with the owner, but we're advising the owner of what's required, what's not required. We do have a 24-hour emergency maintenance. So yes, at 3 a.m., somebody is available to handle emergency calls, especially involving water that could damage your property. The move out is another big issue with people who manage it themselves. Damage happens, wear and tear happens. You need to know what's the difference. According to a tenant, all of it's wear and tear. But it's not. So most of the owners who have done it themselves, who I've come across, they just go ahead and pay for it. They don't, they're scared of the tenant. A lot of tenants know what they're doing. I mean, they threaten lawsuits or threaten to go to a tenant advocacy, and they say that they are not responsible. So owners, a lot of times, they don't want to fight. They just pay for it and then turn around and get the next tenant. We protect that. We take care of that. We have vendors that we've worked with for years, and we get that property ready and turn it around quickly for the next tenant. So it's, yes, there are some fees involved. It's a business, but in my experience, those fees are more than covered in the rent that we get and the protection as far as maintenance, and then the back end inspection. Nobody that I've ever had that's managed themselves has come in and said, this is easy, but I just want to have somebody else manage it. No, they learn the hard way. They've lost a lot of money, and then they come and have us do it. And they invariably in the next year or two say, we're making more money having you manage it, even with the fees, than what we did it ourselves, and we don't have any of the headache or hassle. In a nutshell, that's it.
Yeah, I will
That's
second that too. I think having a management company is so powerful and really the only way to make it scalable. So big picture, if you want to acquire multiple properties, this is critical to making that happen.
Yeah, and I started, like Dan had mentioned, it's kind of a slow and steady wins the race type of investment. And so years ago, we bought our first rental property, and then we bought another one, and then another one. And, because each of them are cash flowing. So you said we buy another one. So we have 14 now, and that's literally our retirement. That's funding our retirement. And so it's just good to look at the numbers that Dan gave. It might not be so amazing at the very beginning, but you just got to remember it's a building. It builds upon itself.
I remember Suzette saying 10 doors, and I've never forgotten that.
Yeah.
And I think once you start going, it's easier, right? It's the first one I think that everybody has the hardest time with.
It is, because it's a lot at the beginning. It's a lot of numbers thrown at you. You've got to come up with the initial, down payment. You've got to come up with the fees and involve everything involved with property management, which aren't as much as what you would think they are. And so at the very beginning, like Deanna mentioned, it's not as huge payoff. If it was, yeah, that'd be great, but it's still a payoff.
So I'm going to switch really quick just because we just have a couple minutes left. And I just wanted to know your opinions on Dana, or, all of you, like, about flipping. Have you ever done any flipping, Suzette?
Yeah. Yes. And some properties, it depends on the market, honestly. It really depends on the market. For the most part, if you're wanting this as an investment or as a potential retirement supplement, even if you don't want it for all your retirement, it's better for buy and hold. But sometimes certain markets, it's good to flip it.
Yeah. So knowing what market
Yeah, and
you're
you might Yeah, and you might run into a property that just is primed for a flip, you know, so I think it's hard to repeat flipping success. Buy and hold generally works in almost every market. Flipping works in, you know, certain markets. So, you know, like Suzette said, it's just something that starts to snowball in a really cool way. The more properties you acquire, the easier it is to acquire more. And the passive income will eventually come at the end.
So Dan, where do you find your sweet spot? Is your sweet spot like 9 to 10 as well? Is that where you seem to see where people go, or do they continue like Suzette 14, 20? I know we have people who have apartment complexes, right? But the average person, where do you see them headed or ending up?
Most investors, the goal is simply more. That's what I find. You sort of get addicted to investing once it starts to snowball. And the better your cash flow is, the easier it is to get more. And, you know, from a conventional financing standpoint, 10 properties is relatively easy because Fannie Mae, Freddie Mac will allow you to finance 10 properties. And they consider financed properties. So once a property is free and clear, it doesn't count in that limitation. And your primary home also does not count in that limitation. So when you get beyond 10, then you have to look at other sources of financing, commercial banks and those types of things. That's where it gets a little bit trickier, and the reserve requirements increase the more properties you acquire. So you have to be a little bit more financially robust to continue. But as the properties build, you're going to be. That's generally going to be the case. So the first 10, and that's why a lot of people, I think, have that 10-door goal, because that's where the financing sweet spot really is for conventional. Beyond 10 doors, then you have to get outside the box financing or commercial financing.
Okay. Good to know. I didn't know that. Okay, so I think that, and I want to thank everybody very much for being on here. That went pretty quickly, actually. We have 6 minutes left. Sherry, did you have any questions or anybody? Sherry does. Okay. If you didn't put it in the chat, you can just unmute yourself.
Okay, so my question is, mentioned, so what are the markets? What do you look for in a market if you know that it's time to flip something as opposed to just buy it and hold it? What is the difference of the market?
In my opinion, if it's a seller's market, when you can do it, you can't. This is just my own experience. When we were doing flipping, it needs to be a market where you can sell it quickly, where there's demand. Because if it's a buyer's market and there's just a lot of inventory out there, many flippers, they do a different type of financing, and it's typically expensive financing, and so you don't want to sit there and hold that property for too long in a market that's just not good for flipping. So it's really kind of a timing issue, finding, you know, because in a seller's market, then it's kind of hard to find that great buy on the one side. So it's tricky. It's trickier for flipping. That's why buying and holding is it's more solid. Like Dan said, you can always do a buy and hold. It's good anytime. But there are some little pockets when it's a seller's market.
And I would definitely say, when you're doing it, if you decide to flip, that if you have never picked up a hammer, don't do it yourself. I've seen so many flips gone bad. It's not even funny, from owners who decided to flip it. I saw a microwave that was like 6 feet high. You know, not even a joke. I've seen everything from people thinking that was good enough, you know. So if you're going to decide to do a flip, make sure you have a realtor who can tell you how much money you can actually, you know, potentially make from what you're doing in the house, right? Make sure you have a timeline that you stick with and a budget to hire professionals, right? Because people think they can do it themselves. It takes longer than they think. It's more work than they think. And halfway through, they're looking for me to find somebody to help them finish it, you know? So, and how about you, Dan? Did you have something to piggyback on that?
Yeah, I think it's important to have your crew in place ahead of time. You got to have your contractors. You got to have all of your ducks in a row if you're going to flip a property. And I think most flippers are going to pay a lot of tuition out of the gate. You're going to not make a lot of money on the first few, and you eventually sort of figure it out. You figure out the formula that works for you, and you make money on the buy. You have to be able to buy the property for the right price to be able to put all that work into it and still resell it at a profit. You know, like Suzette said, there are specialized financing for flips. It's designed to be very short term. Get in, get out. You're going to pay some higher rates and higher fees because it is short term. That's the only way they can make money. So there are a lot of financing options for that. It is just a little bit trickier to pull off. But again, a lot of people, that's all they do is flips. So, you know, I think certain investors are suited to different things, and certain properties are probably suited to different things. And the market timing is the trickier part of flipping. So if you get it wrong, you could potentially lose quite a bit. Buy and hold is a strategy that generally, just given a long enough timeline, you're going to win. So.
Yeah, definitely. Christine wanted to text me and said she can't unmute for some reason, but the home warranty can be used for investors. So if you go through Driggs Title, they offer a 1-year home warranty on any of the homes that you go through them with, which is a great, you know, another little bonus for people who are do-it-yourselfers. Okay, so I thank every one of you for being here. I do want to honor your time. I do believe thank you all. I mean, great information. And we're definitely going to be putting little snippets of this up on our YouTube channel as well, so that everybody can go back to that. And I'd love to invite you back, because I you know, as we continue to do this, and we're going to do some evening ones, I do want to get deeper into this and continue to grow this little Zoom thing here. So I appreciate all of you for joining us today. Thank you. Amy's on our team. She joined a little bit late, but I want to acknowledge that she's here too. And Christine, thank you for always. Haley, thanks for sending these out to everybody. And hopefully we'll see you again soon. We're going to start doing these every 3rd Tuesday of the month. Okay, so mark your calendars. All right, guys, thanks again and have a wonderful week.
Thanks so much, everybody. Appreciate it.
Thank you. Bye-bye now.